Hello traders, James Stanley with StoneX and FOREX.com. Wanted to take a look at dollar yen. There's a lot of drama around the pair right now, and the thing that was most troubling to me, or is how seemingly bullish much of the crowd remains to be. Now that said, I've been a dollar yen bull for a long time, but I think it's always important to explore the other side of each of these arguments. And the more that I've looked at a contrarian case for gold, the more I've become interested in that side of the matter. And I wanted to use this video to go over that. As usual, I'm going to retain balance. I think that that's the only professional way to handle such matters, but I want to explore that contrarian case for dollar yen in this video. First, need to look at a risk disclaimer. I'm going to leave that up for 15 seconds up front, 45 seconds on the back, and it will be in the description field of this video. Please review that. Pause the video, take more time to review that if you so need. I will be on the other side, and we'll start looking at charts. Okay, first things first, the why. If we look at dollar yen over the last 5 years, there has been a clear, definable trend. And that trend very much remains in place. If we take this low from the first week of 2021 and we draw it up to current price, you'll see there is a 53.57% move in that pair. That's amazing for a currency pair. That's significant weakness in the Japanese yen against the US dollar. And I've looked at this multiple times in multiple angles, in multiple venues, in webinars, videos, articles, etc., where if this weakness in the Japanese yen was not present to this degree, the US dollar would be far weaker. And that's something that President Trump has talked about wanting for some time now. And US Treasury Secretary Scott Bessent seems more than happy to do President Trump's bidding, and that is one of the items that leads us to current day. Now, if we go back to that trend, you'll notice that it's not straight up, it's not linear. There are multiple episodes of counter trend in here, and those movements down are somewhat violent. Even though the fundamental divergence is long and clearly biased to the long side of the pair, it's the moves down that are probably even more violent than the moves up. And I'm going to focus on this one in this video because I think there is an excellent template for what happened then that could be applied to now. But first, I want to just look at the matter from a near-term perspective and current lens. At this point, we had a massive down week last week in dollar yen. And what happened? An intervention. Traditionally, interventions from Japan don't work. They have short half-life, and we get episodes like we saw last year, or excuse me, in 2024, with the 160 intervention. Like dollar yen ticked up to 160, briefly BOJ intervenes. It's a week of weakness, and then buyers just load the boat. Why? Well, because the long side of the pair is still being biased for carry. Interest rates in the U.S. are significantly higher than in Japan. Retail traders can earn rollover by holding the pair at rollover at 5 p.m. Eastern time. I don't think that's the biggest and most significant driver. I'm going to explain that in this video. But again, first, just want to go back to this current lens. Now, we had that aggressive sell-off. It continued through this week's open, and so far we've had a bounce. Now, we're just about the halfway point of the week as I record this video right now, and this actually takes on the look of a bullish candle. So this isn't something where I just want to like automatically press bearishness, because I don't think that we're there yet, but I think that's something that could be playing out in the weeks ahead. At this point, I have dollar yen at a significant area, 157.87 up to like 158.09. 160, I think, is the big handle. Now, the reason that I think these are so significant is because we have seen such a clear and visible path from U.S. Treasury Secretary Scott Bessent, from the Japanese side, from Katayama. We've heard Sanae Takeichi commenting around the matter a bit. And both economies, both sides policymakers want to see this spot quote go down. And while BOJ interventions solo have often failed, dual interventions with both the U.S. and Japan, much different record. Like as a case in point, in the late 90s, we had a similar scenario. The U.S. joining an intervention is ultimately what arrested the rally in dollar yen and brought matters back down. But what we're looking at now is to me more similar to what happened in here. Now, if we go back to 2022, at that point, you're seeing that fundamental divergence flare massively. The U.S. is hiking rates, and through the summer, it was the 75 bip rate hike increments. Japan is not hiking rates. That leads to this. I mean, again, it's a significant trend. We got all the way up to 150, 195 after starting 2021 down at like 102.59. So that's almost like 5,000 pips in less than 2 years in a major currency pair from two of the world's largest economies. Now, this does a couple of things. One, it's a massive lift or boost to Japanese growth because Japanese exports that much cheaper in the U.S. It's also a hindrance to the U.S. because the dollar is a lot stronger than it would be if the Japanese yen had kept pace to some degree, or at least to less of a degree than it, or more of a degree than it did. But we get up to this point of 150, and even before then, there was a lot of posturing from the Bank of Japan. Their concern on this is they don't want the yen too weak, because if it is, then that brings on inflationary pressure that they might not be able to control. They might not be able to manage. They might be forced to be in a position like the Fed was in 2022, where they have to hike rates aggressively and risk choking off any and all growth. They tried to intervene at 145. You see, it didn't really work. Again, these solo BOJ interventions, there's not a good history there. It got a pullback to 140.30, and then bulls just loaded the boat, took it right back up. 151, or 150 rather, was a different story. This is when the BOJ came in with size. It was you look at this on the daily chart, it was a really worrying Friday morning because we went into that period right in here, and you can see where bulls are just like tiptoeing. Once we get above 145, it's kind of like the hand in the cookie jar. You're just going to reach a little bit more, a little bit more, a little bit more. We finally get above 150, and then they go for broke on a Friday. And ultimately, the BOJ had to scream uncle. 150, 195 is what topped it, and that got us a pullback. But it's what happened after that that's relevant to right now. Again, this was one of those solo interventions. This was just the BOJ on their own. There was no help from the Fed or from the U.S. Treasury. But it was enough to quell the rally. Now, initially, bulls stayed very active, and that's what's similar to what's going on today. Bulls still pretty active. It's like we looked down on that weekly bar. You could even call that a bullish candle right now. Still halfway through the week, but if we close as a hammer, that's going to look bullish for a pullback. And same thing here. You look at initial move off of 150, right? We get down, we see support at just above 145, and buyers pounce. But it's as we get close to that line in the sand, that 150 level, buyers all of a sudden get shy. Now, that was not an impending breakdown. That just stalled the rally. But here's what broke that trend down. November 10th, 2022 was a US CPI release. Now, here's the funny thing. Core CPI for that print came in at 6.3%. Like more than 3 times above the Fed's 2% target. Headline CPI for that print came in at 7.7%, almost 4 times the Fed's target. Massive inflation. No reason for the Fed to be cutting rates at all. But both numbers were a reduction from the prior month, and they were below expected. The headline CPI print was expected at 8% flat, came in at 7.7%. The core CPI print for that period was expected at 6.5%, came in at 6.3%. But it was enough for longs that had held on throughout the ride to say, you know what? I'm going to take my profits off the table. And that's what led to the spiraling sell-off in dollar yen. That lasted for the next 2 months. We didn't bottom until January 13th of the next year. But this is a clear case, a clear illustration of where the fundamental divergence in a pair isn't necessarily always going to drive the trend. But it wasn't the BOJ intervention that got the reversal. That just stalled the rally. It stalled the rally long enough for worsening U.S. data to bring in the reversal setup. Now, eventually, buyers just jump back on the bid, and they drive price right back up. And eventually, it goes up to the same 150, 195 level until another below expected US CPI print compels another pullback. Now, ultimately, this thing broke out with aggression. And you want to guess what it was? There on April 10th, 2024, a US CPI print. above expected this time, dashing hopes for the Fed to cut rates later in the year. And that's ultimately what sent the pair up to 160 before the BOJ intervened, which failed. Buyers jump in at 150, 195, and then rally it back up. But the whole point of bringing this on is if we look at what's actually underpinning this whole trade, it's not just retail traders chasing swap or rollover. No, it's sophisticated institutional market players using the carry trade for what it actually is. It's a form of possible arbitrage. Because if you go to a Japanese bank and get a loan at 1% when Japanese bank rates are near 0%, and then you could go to an economy like the US that has lifting rates, that has higher rates, especially if they're coming in 75 bip chunks from the Fed, and invest that capital in a low risk type of investment, there's a form of arbitrage in there. Now, it's not perfect, it's not clean, because the loan that you're getting in Japan is in yen, and you're investing it in the US and USD. And if the yen is continuing to weaken because the Bank of Japan is not keeping up with US rate policy, well, then you could watch any profit that you might get off of that spread go up in smoke. So you're a hedge fund. What are you going to do? Going to hedge that risk. And how do you hedge that risk? You hedge that risk by selling in the marketplace and buying USD. Now, as long as the trade is going in this direction, all is good and fine. You're actually profiting off of that hedge, and that's wiping away any losses you might have in the actual underlying of JPY. But the second that it starts to go the other way, when it starts to seem as though that trend might turn, there's little reason for keeping that hedge on. And that's why this move could get so violent so quickly. And that's why these oversold readings, they don't matter. You have hedge funds, you have institutional market players that are just cutting those hedges because they don't want to lose on a component of a trade that's just designed to manage currency risk. And that's why these things can move so fast when they do happen. That's why it's up the stairs and down the elevator. Now, current stage, we're not quite there yet. All that we have is the first part of the story where the Bank of Japan has stepped in, but this time they've had help from the Treasury Department. Both economies want to see a lower spot rate in dollar yen. And if we look at the backdrop, there's rationale for it. Right now in Japan, the most recent prints were 1.6 and 1.7% for core and headline CPI out of Japan. So there's little reason for the BOJ to be lifting rates right now. And the Fed, they're widely expected to be hiking rates later this year. You see right now, current 81% probability of at least one rate hike into the end of the year. Even going into September, there's a 52.9% probability of a 25 bip hike. But this is where that game plays. Because if we see US data worsening, if we see inflation numbers softening, if we see employment numbers softening, there's less reason for longs to hold on to those hedges. And I got another example here from recent history in dollar yen as to why and how the drives behind this aren't just from the fundamental data. If we look at what happened back in July of 2011, it was another one of those episodes. So when we had the 160 test that failed, buyers just drove this right back above 160. This time, the Bank of Japan kind of seemed a little bit irked. And so they didn't just intervene on a 160 break. They waited till the morning of a US CPI print, which came out below expected. Now, that was a special CPI print because that's the one that gave hope that the Fed would actually be able to cut rates in 2024. A below expected US CPI print, rising odds of US rate cuts, and a Japanese yen intervention. It didn't take long for this thing to start spiraling out of control. But do you want to know when it bottomed? 2 days before the Fed actually started cutting rates, 2 days before a 50 bip rate cut. Dollar yen finds the support around the 140 handle and begins to bounce. This cycle entailed 1,800 pips in a little under 4 months. And the Fed was cutting rates throughout. They cut rates 3 times for 100 bips, 100 basis points, 1% over that period. And the reason is because the fundamental divergence between these economies, it remained in place. It was just lessening. But for those institutional carry traders, there was reason to have that hedge back on, as all of a sudden the yen wasn't so cheap. The dollar wasn't so expensive. And so even though the Fed is cutting rates and the Bank of Japan is not, the market is ripping higher, helped along by that continued divergence. So all of that to say, right now, the long side of dollar yen feels very vulnerable. The fundamental divergence, it's still there. But I think that there's a rising probability for a theoretical cap to upside in dollar yen, at least for now, because we have seen such a visceral response from Scott Bessent, from the Japanese side. I think if we get back up to 160, I think that's something that could be problematic again. And perhaps that itself doesn't substantiate a bear case, but it does make the bull case less enticing, especially if there's only theoretically 200 pips of possible upside if that 160 cap is going to come into play. So, like I looked at in the weekend video, dollar yen around 155 still kind of attractive on the long side because it doesn't make sense for an intervention at 155, especially with given facts. But at a 158, that short starts to make a little bit more attraction. And if we do break out and get closer to that 160 handle, and if you're one of those institutional players and you still have a hedge on and you have a chance to wiggle out a dollar yen at 160 and change, that's a compelling argument to be made. But it at least puts the pair on its back foot long enough to where worsening US data could compel a larger reversal type of scenario. And this is very similar to what we saw in Q4 of 2022. Again, I think the thing that can't be understated is the importance of the US Treasury jumping in on matters. It's clear as to why they want to cap dollar yen upside. Because if they don't, not only does the dollar remain stronger, but you also have more and more of a likelihood that Japan's going to sell some treasuries. And if Japan sells treasuries, the US sees higher rates. That's not something that Scott Bessent wants to deal with all of the US debt maturing over the next 4 months and then over the next year. So there's a lot going on here, but a story that's wrapped in intrigue, and I wanted to address it with the Contrarian case in this video. Hope you liked it. Let us know what you think. Like, subscribe, all that good stuff. Comment. Let me know your thoughts. But thank you for your time, and as always, happy trading, ladies and gentlemen.